Next we have B5M2, Market Influences on Business Part 1, what we will be covering in this module, the laws of demand and supply, elasticity of demand and supply, and effect of inflation on price, investment, debt, and future expansion. Let us first discuss the law of demand. All right, here we go. Just look at the right of your screen. What you see, if the latte is for free, 16 would be demanded. When the price is raised to $1, the quantity demanded falls. If the price increase further, the quantity demanded will fall further. And as we keep on increasing the price, the quantity demanded progressively falls. So at this particular level, this is the maximum latte the consumers are willing to buy at this price level. At this price level, this is the maximum quantity of latte the consumers will be willing to buy. Now, if you just plot this, where we take quantity of lattes on the x-axis, price on the y-axis, what you see these at 4, the combination is 8, 4, and then 5, 6, and finally when the price is 6, only 4 lattes are demanded. So this would what you call the demand curve. So this demand curve shows the quantity demanded on the x-axis and the price on the y-axis. So you can see if the price is increased from 4 to 5, the quantity demanded will fall from 8 to 6, right? And vice versa, if the price is decreased from 5 to 4, the quantity demanded would increase from 6 to 8. So now you can see that because of change in price, we are sliding up, down, up, down. So if there is change in price, the quantity demanded falls, and if there is reduction in price, the quantity demanded increases, keeping the other factors same. This is called the law of demand. And because of changes in price of that particular good, latte in this case, you are on the same curve, slide up and down. This is called movement along the demand curve. This is not always true. Let's say if the winter season sets in, right? People are now willing to purchase more quantity of latte even at the same price, right? So when the winter sets in, there is no change in price, the more lattes are being demanded. This is called the demand curve shifters. If other factors which we kept constant, like fashion, taste, trend, weather, price of substitutes, price of complementary goods, if they come into action, they will cause the shift in the demand curve like this. And conversely speaking, in our part of the world where I live, people don't like coffees and warm stuff in summer. So you would see an inward demand curve for such item. So this is a nice graph that will explain the idea. Because of increase or decrease in price, the quantity demanded changes. You move up and down the same diagram. This is called change in quantity demanded. Changes in price cause the movement along the demand curve. But if there are other factors which we bring in action, like fashion, taste, trend, price of complementary goods, price of substitutes, income levels, population, so on and so forth, this would result in change in demand. The demand curve can shift outwards, sometimes called shift to the right. It can shift inwards or shift to the left. So this is called the change in demand. This is very important. You need to distinguish between these two. Change in quantity demanded is caused by the price of that product, and change in demand, increase or decrease, shift outward, shift inward, shift to the left, shift to the right, it is caused by factors other than price, and the list can be enormously long. Now let us try to interpret the law of demand in some suitable way that is more convincing to our senses. So let us consider a certain item that is currently priced at x1, and at this price the quantity demanded is x1. px1 is the price and x1 is the quantity demanded. When the price is lowered to px2, since it's cheaper now, we tend to buy more. So let us try to interpret, this is called the law of demand. When the price increases of a product, its quantity demanded falls, and when the price falls, the quantity demanded increases, keeping the other factors constant. Now let us explain this law through two effects. One is the substitution effect. Now, if the price decreases in our example from x1 to x2, we were previously consuming an item y1. Now because x is cheaper now, x is now available at px2 at a lower price. Now I will lower my consumption on item y. Now I will start y2 consuming the units of y, and the money saved from Y will now be used to purchase more X. This is called the substitution effect. The item that becomes cheaper, you tend to buy more of it, substituting your spending from other items, and will channel your funds to purchasing more of X. And other aspect to it we can explain is called the income effect. If the item X becomes cheaper, now it means your income in the total stays the same. Since the price has fallen, your income can now purchase more of X. Your income is the same, but since X has become cheaper, now you can purchase more of X. This is called the income effect, right? So we can say that the quantity demanded and the price, they are inversely related with one another, and this inverse relationship is because of substitution effect and the income effect. Now let us discuss some factors other than price that can cause the demand curve change, the shift inward and outward. First, changes in wealth. If you become richer, you might start buying more of a particular item, so the demand curve shift outwards. If you become poorer, the wealth level falls, you'll buy less. Changes in the price of related goods. Let's say we have cars on the x-axis. If the fuel becomes cheaper, if the fuel price falls, the cars will become now more affordable, so the demand for cars go up. Conversely speaking, like right now in my country, the fuel prices have gone enormously high. So the high fuel prices will discourage the purchase of vehicles, so the demand for vehicles, motor vehicles, will fall. Consumer income change. If consumer get more disposable income, they can spend more, the demand increases. If the income falls, the demand falls. The demand would move, demand curve move to the inwards. Changes in the taste or preferences. Again, it will have the same effect. Preferences in favor of a particular product will cause the demand curve to shift outwards, and preferences away from this product will cause the demand curve to shift inward or shift to the left. And changes in the consumer's expectations. If you expect the economy to do well in the next 5 years, you tend to buy more of a particular product, means the demand curve will shift outwards. And conversely, if you expect the economy to do badly in the future, so you will buy less of a particular commodity, so the demand curve will shift inward. And then finally, with the increase in population, there are more buyers. More buyers mean more demand for the goods and services, and less buyers mean the less demand. All these are the factors other than price that can cause the shift in the demand curve. Next, we have the supply, the law of supply. Let's say right now the price of a particular item is 3, and at this price 1000 units are supplied in the market. When the price goes up, as a seller, I would supply more. When the price goes even higher, I would be willing to supply more. As the price keeps on going up and up, I would be willing to supply more and more. So supply curve tends to be positively correlated with price. If the price goes up, the quantity supplied goes up, and if the price falls, the quantity supplied falls as well. Now, just like the case we saw in the law of demand, the quantity demanded depends upon the price, and you move up and down the same demand curve. Similarly, when the price is P1, the quantity supplied is X1. When the price is increased, it's an indication for the supplier to supply more. So higher prices mean the supplier will be willing to supply more. So change in quantity supplied moves along the supply curve depending upon the level of prevalent prices. But changes in supply caused by technological improvement, caused by time dimension, this would shift the complete supply curve outward or inward. Increase in supply, decrease in supply will result in the supply curve changing its position. Now, how does it happen? Changes in the price expectations of the supply firm. If you expect the price in the future to fall, you will tend to supply more and more and more and more, so the supply curve will shift outwards. And if you expect the prices to go up in the future, so right now you tend to supply less and less. So changes in price expectations will also shift the supply curve inward and outward. Changes in the production cost, price of inputs, material, labor, variable and fixed overheads. If the cost of production falls, that means you can now afford to produce more units. So the supply curve will shift outwards. And conversely speaking, if the cost of production goes up, you can not produce more because your material, labor or overheads are now at a higher level. So the supply curve will shift inwards. Okay, changes in price or demand of other goods. Let us first discuss price. If some other items price go up, So people will look for alternative. So you can now push more. You can increase your supply. And if the price falls, and your product may be a substitute for that, in that case, you may not be able to sell as much, so your supply will go inwards. And of course, demand will have the same dynamic. If the demand goes up of other products, then you may have to lower your supply, or if the demand falls, then you may push your product for sale. Next, the changes in subsidies. Subsidies are government support to the firm, and they may be in the form of cash, in the form of reduction in input price, or it could just be reduction in taxes for certain firms or certain industry. So if subsidies are given, in that case you will be able to supply more. In that, supply curve will shift outwards, and reduction in subsidies means the supply curve would shift inward. Likewise for taxes, changes in tax. If tax rate is increased, means the firm will have less resources to produce, so the supply curve will shift inwards. And conversely, if the tax rates fall, then the firm will be able to supply more. In that case, supply curve will shift outwards. Then changes in production technology. If there is a revolution in production, some new equipment which is now able to produce more, then clearly the supply curve will shift outwards. Market equilibrium basically is interplay of demand and supply. A market is said to be in equilibrium when there are no forces acting to change the current quantity demanded and current quantity supplied. Let's say your market is currently in equilibrium at price 10, because at this price level the quantity demanded and quantity supplied is the same. Things can go wrong, or things may not be in equilibrium if the equilibrium is not maintained, if the quantity demanded is more or less than supply. Like for example, if the price is $9, at this price the quantity demanded is more, but at this price the supplier is willing to supply less. So this means the quantity demanded is more than supply, so there is going to be this much shortage, QD minus QS, or just this gap. And in case if, of course clearly this is not a stable situation, market will come back to equilibrium. Market price will rise because more people are willing to purchase. So this increased demand would raise the price up, and eventually the point will revert to this equilibrium. Now let us say if the price is $12, at this price the supplier is willing to supply more, but the customer is willing to buy less. So in this case, quantity supplied is more than quantity demanded. This is called a surplus. Again, this is not a situation that can sustain. It is not a stable situation. It is disequilibrium. What will happen? Since the price is high, the customers will not be willing to buy, so the supplier will have to lower the price, and the price will fall back to $10, and the market will attain equilibrium again. Equilibrium can also be caused by changes in demand. Like if this is the original demand curve, and because of increase in population or consumer preferences, the demand curve can shift outward, so the new equilibrium quantity will be Q1 and new price will be P1. And likewise, change in preferences, taste, fashion, trend, the demand curve can shift inwards. In that case, the equilibrium quantity will shift from Q to Q1 and price will fall from P to P1. Same can happen when the supply shifts. Like because of technological improvement, the supply curve has moved outwards. The quantity equilibrium has moved from Q to Q1. Price has fallen from P to P1. And because of maybe increase in taxes or perhaps production bottlenecks, less number of firms in the particular industry, supply falls, equilibrium quantity will fall, and the price will go up. Now, it is possible on your exam that you might be required to assess the simultaneous changes in demand and supply. Okay, now let us discuss few cases. In first case, the demand increases to D1, and at the same time supply increases to a new position S1. What we can see that the quantity demanded and supplied has moved a new equilibrium quantity is Q2, this one. So this is, we are for sure, this is the new equilibrium quantity, and it definitely is higher than the previous one, but we are not sure whether the new equilibrium price is higher or lower, because it depends upon the relative increase in demand and supply, new demand and supply. So we can't be sure about the equilibrium price. Next, increase in demand and decrease in supply. See, this is the new supply curve. So what happens? The price definitely goes up. We are sure about the equilibrium price, but we are not very sure regarding the quantity, because the supply and demand, they may move disproportionately. So the quantity demanded is indeterminate, but the price is definitely going to go up. In the third case, supply decreases to new level S1, demand decreases to the new level D1, and resultantly the quantity demanded falls, quantity supplied falls. New equilibrium quantity will fall, that's for sure. But what about the new price, new equilibrium price? It could be higher or lower than the current price, so we are not sure about the equilibrium price. Lastly, demand decreases, supply increases. What we are sure that the price will fall. You can see the new equilibrium point showing a lower price, but we are not sure regarding the quantity, the equilibrium quantity. So equilibrium quantity is indeterminate, but the price will definitely fall. So this is how you can answer many exam questions. Just draw the demand and supply curve, shift them in outward, and then you can see what would be the new situation. Next, we have a very important topic, government intervention in the market operation. Let's say this is the current market price of a certain commodity, and this is the current quantity. If the government sets a price ceiling, remember, price ceiling is also called the maximum price, and in order for maximum price to be effective, it must be below the equilibrium point. This is the maximum price. At this price, the quantity demanded is more than the quantity supplied, so this would cause shortage. Price ceiling results in shortages. On the other side, price floors, or the minimum price is always should be kept at above the equilibrium price. At this point, the quantity supplied is more than the quantity demanded, so this will result in surplus. So remember, price ceilings result in shortages and price floors results in surpluses. Next, we have a good example of government intervention in accommodations. Apartments, price ceiling, rent control apartments exist in some places. The price is required by the government mandate to remain at a certain level below the market price. So you're talking about somewhere here. So this means there is more demand for the apartments, the supply is less, this would result in shortages. Let us see. The result is an artificially high demand of those apartments, shortage. There may be policy reason for having rent controls, but the economic result is that there is a shortage of apartments. Now the other picture, price floors. You can always find supporters of increasing the minimum wage in the United States. However, businesses hiring minimum wage workers counter that they will be able to hire fewer people. When the minimum wage goes up, the employers will hire less because the rates are higher, thus creating a higher unemployment rate resulting in surplus workers. Let me show somewhere here. Let's say this is the supply of labor, this is the demand for labor. If the minimum wage rate set is at this point, the employer is not willing to hire the more workers at this high wage rate. Resultantly, he will lay some staff off. There will be surplus of workers, surplus of labor in the market, resulting in higher unemployment. Next, we have elasticity of demand. This is a very important area. What is elasticity of demand? Elasticity of demand basically is a measure to assess how responsive the demand is with respect to changes in price. This is calculated by dividing the percentage change in quantity demanded with percentage change in price. Let's say, suppose that when price of a product increases from 100 to 120, indicating 20% increase, quantity demanded decreases from 1000 to 900, so that's about 10% decrease. So the percentage change in quantity demanded is 10% negative, there is a reduction, and the increase in price is 20%. If you simplify, the result is negative 0.2. In absolute terms, it's 0.2. So elasticity of demand is 0.2. What does it mean? How we can interpret? 0.2 means if there is 1% increase in price, the quantity demanded falls by 0.2%. Or if the price falls by 1%, the quantity demanded goes up by 0.2%. So you can see the demand is less responsive. Demand is less responsive. So this brings us to a conclusion that when the price elasticity of demand, the absolute value, it is less than 1, the elasticity of that particular product or service is said to be relatively inelastic. It is less responsive. Let us discuss this idea further. Now look at this. We have some special graphs. We have quantity demanded on the x-axis, price on the y-axis. Look at this. The price jumps from P1 to P2 or falls from P to P1, but there is no change in demand. In such a case, the price elasticity of demand, if calculated, would be 0. This would be true for a person who is sick, maybe a diabetic patient or a heart patient who needs to take 1 tablet per day. And that means no matter what the price of that tablet is, he is going to consume the same number of tablets per month or per day. So for him, the price elasticity of demand is 0. In the next case, look at this. If you calculate the price elasticity of demand, just like in our previous example, it was 0.2. 1% increase in price causes the demand decrease by 0.2%, means the demand is less responsive. So whenever PED is less than 1, the formula that we discussed a little while ago, the result of this formula, if the absolute amount is less than 1, the demand is said to be relatively inelastic. So this would be true for food items, fuel, consumables, fast-moving consumer goods. For such items, the demand is relatively inelastic. The demand is less responsive to changes in price. And in such a case, if the price is increased, the quantity demand will fall by less proportion. The total revenue for the firm would increase, and on the other side, the total expenditure for the consumers will go up, because total revenue from the firm side and the expenditure from the consumer side. Now the third case, PED is equal to 1. In this case, if the price goes up, the quantity demanded falls by the same proportion in such a way that the total revenue stays the same no matter whether you increase the price or the decrease in price. So price goes up, quantity falls, price goes down, quantity demand goes up. The total revenue from the firm side and total expenditure from the consumer side stays the same. In case if the PED is infinity, the demand is said to be perfectly elastic. No matter what's the quantity demanded, like in perfectly competitive market, if the prevalent price is $10, you will have to buy it at $10 and you will have to sell it at $10. There is nothing in your control. And in case if the PED is greater than 1, it means the demand is more responsive to the changes in price. If the price goes up, the quantity demanded falls, and conversely speaking, if the price falls, the quantity demanded goes up. In this case, if the price decreases, quantity demanded goes up, total revenue goes up, total expenditure goes up. And if the price increases, the quantity demanded falls, total revenue falls, total expenditure of the consumers fall. This is how you can interpret. Next, this is we have already covered. Price elasticity of demand is greater than 1, that is elastic, relatively elastic. If the price increases, the total revenue falls. If the price is decreased, the total revenue goes up. We discussed this. Inelastic means having PED less than 1. If the price increases, total revenue goes up. If the price falls, the total revenue goes down. If it is unitary elastic, the total revenue is unchanged, and in PED in that case is equal to 1. Total revenue is unchanged with the increase or decrease. Next we have the price elasticity of supply. It is calculated in the same way, percentage in quantity, change in quantity supplied upon the percentage change in price, and then just simply plug in the numbers. Like we have a certain item, its price is changed from 10 to 11. The quantity supplied goes up from 500 to 600. So the percentage change in quantity supplied is 20%. The percentage change in price is 10. So you're going to divide 20 by 10. The result is 2. It means the price elasticity of supply is greater than 1, so it's relatively elastic. The same ideas goes with it. We have just discussed it a little while earlier. The supply cannot be changed in the short run. PS is 0. Price elasticity of supply is infinity. Less than 1, greater than 1, equal to 1. The dynamics of these are exactly the same as we have done previously. Factors affecting elasticity of supply. First is storage. If the product can be stored, it can have a longer shelf life, then supply is said to be more elastic. If it can't be stored, then supply elasticity would be less. Similarly, time required to produce. If it takes very little time to produce, then the elasticity of supply would be greater than 1. What if it takes more time to produce, then the elasticity of supply would be less than 1, right? And next concept is an interesting one called the cross elasticity. And here we come up with the two ideas, substitutes and complementary. Okay, two items are said to be substitutes if one can be used for another, like for example, Pepsi and Coke. And if you calculate cross elasticity for Pepsi and Coke, the result would be a positive coefficient. Let me show you. Right now, the price of Pepsi is, let's say, $10. The quantity demanded is 100. Right? Call it good X and call it good Y, so as we can plug the numbers here. And at the same time, the price of Coke is $8. The quantity demanded is 90, for example. Now, let's say for our good Y, the price increases from $8 to $10, right? Now, what will happen? These customers who were purchasing Coke, they will shift their demand to Pepsi, and now the demand for Pepsi goes up to 130, right? So the demand for Pepsi has gone up by 30 units, whereas the price of Coke has gone up by $2. Let us calculate and see. So increase in price of Coke plus has caused increase in the demand for Pepsi, and likewise, if the Coke price goes down, there will be more demand for Coke and less demand for Pepsi. So they will either move up together or they move down together. That's why when you will calculate the cross elasticity, result will be positive. So let's do it now. Look at this. The change in price of Y is $2. 2 by 8, that is 25%. And change in quantity demanded for Pepsi is 30 by 100, that's 30%. So the result is positive clearly, so it will give you a positive coefficient. Now let's say if two products are complementary, which are jointly demanded, like bread and butter. Bread and butter, when you will calculate their cross elasticity, result will be a negative coefficient. Let's call it X and call it Y. These items are jointly demanded. Like if the price of butter goes up, people will demand less of butter, and since butter and bread are jointly demanded, so the quantity demanded of bread will fall. So if the price of butter goes up, the demand of bread falls, indicating a negative relationship between them. And if you calculate the cross elasticity between these two, you will get a negative coefficient, just like we calculated for these substitutes. For substitutes, the coefficient of cross elasticity is positive or negative. If goods are unrelated, totally unrelated, like vehicle and price of computer, totally unrelated. Computers and vehicles, totally unrelated. So for them, cross elasticity would be 0. Next concept we have is income elasticity. How responsive is the demand for a particular product with the certain change in income? So if your income goes up, if your income increases and you start purchasing more of that particular item, the quantity demanded goes up. The good is said to be a normal good, positive income elasticity. And if your income goes up and you start buying less of a certain item, like when the income goes up, you buy less poultry items, less chicken. So in this case, you consider chicken to be an inferior good. In this case, the income elasticity would be negative. Now, the formula is pretty straightforward. You will use the percentage change in number of units of X demanded upon the percentage change in income. If the result is positive, the good is normal. And conversely speaking, if the percentage change in number of units demanded of X and the change in income, if they are in opposite relationship, then it will be an inferior good. So it's fairly straightforward. Let's move on. Next, we have the effects of inflation on price, investment, debt, and future expansion. Effects of inflation on prices. First of all, we need to know what is inflation. Inflation is a persistent or sustained increase in general prices of goods and services over a period of time. When the prices are generally rising in an economy, we say the economy is suffering from high rate of inflation. Okay, so what about the effect of inflation on investment? We'll discuss it from different viewpoints, but just remember first, there are monetary assets and liabilities like cash, account receivables, notes payable. So let us first discuss this from monetary assets point of view. If the rate of inflation, here we will express it with R, is higher, that means the monetary assets will lose its value. Bad for an investor. But at the same time, monetary liabilities will lose the value. That is good for the borrower. At the same time, the rate of inflation is expected to be lower. In that case, the monetary assets value will go up. Investors are happy. And at the same time, those who have borrowed the money, they are in trouble because they will have to pay more in the real terms. So investment in general means when the rate of inflation is higher, the required rate of return is expected to be higher. In that case, the value of your debt investment or equity investment would be high. That's the general rule. Let us discuss in a finer detail. If you made a debt investment and you've made it on a variable rate, so when investment is in a bond or in a note that is tied up with the variable rate of interest, so such a investment will be less sensitive to changes in inflation. But on the other side, if the investment is made in a fixed rate instrument, fixed rate bond, in that case, it is going to be more sensitive to the inflation. This is the general idea, must be kept in mind. What about the equity? We know the DDM model that the price of the stock is equal to the next dividend divided by the cost of equity growth rate. We know inflation feeds into the cost of equity, the required rate of return goes up. If the required rate of return goes up, that means you will have a larger denominator, which means the equity prices will fall. Meaning thereby, if the inflation is expected to be high, in that case, the equity prices will fall. Then we have alternative investments. When we say alternative investment, that means hedge funds, investments in commodities, precious metals. So it is advisable, in order to guard against inflation, investment in alternative investments like hedge funds, precious metals, commodities is advisable because the such assets value move in line with inflation. So you are in a way immunized from the volatility in the price levels, general price levels. Effects of inflation on debt. Okay, now, if the rate of inflation is higher, then the present value of the principal on these bonds or in this debt security would be lower because it is calculated by dividing the principal with 1 plus rate of inflation. So if the rate of inflation is expected to be high, in that case, the present value of the bond would be lower. So if you are a borrower, you will be happy. But if you are an investor, you are going to lose. Now, look at from the other side. If the rate of inflation is low, in that case, the present value of the principal will be higher. Why? Because fixed principal or 1 plus low rate of inflation means you will have high. In that case, if you are a borrower, you will be sad. In case, and if you are an investor, you're going to get a higher value. That means future expenses. If the rate of inflation is expected to be high, in that case, the prices of inputs will go up. That means your cost of production will go up. That means you will have to increase your selling price in order to maintain the margin. The quantity demanded of your goods or service will fall. You will suffer. And on the other side, if the rate of inflation expected is low, or if the prices are falling for the inputs, your cost of production will fall. That means lower prices would feed into higher quantity demanded, higher sales revenue. Here are a few examples to explain these ideas we've just discussed. ABC company is concerned about the potential for rising prices over the next several years. To hedge against inflation, the CFO invests $4 million in TIPS, Treasury Inflation Protected Securities, paying interest at 1.5% and maturing in 3 years. After 1 year, inflation rises to 2.5%. So you will be compensated against that. The new face value of the security is now 4.1 million. That is 2% high. And the coupon rate stays the same and applied on the new coupon means you will get a higher amount of money. So this is how you can protect against the inflation. XYZ issues 1 million 5% fixed rate securities maturing in 10 years. Inflation increases at the rate of 2% per year. The company pays $50,000 in interest cost each year, and at maturity, when the company pays principal of 1 million to its debt holder, it will have a real cost of $820,000 instead of 1 million. Why? Because the inflation has caused the real cost to be lower. Instead of 1 million, the real cost is 820. That's how the borrower will benefit if the rate of inflation is higher. Lastly, a company CFO calculated the labor cost and associated fringe benefits for this year will be 28 million. If inflation averages 2% per year, the same labor and fringe benefit will cost 34 million in 10 years because of inflation. And the company's prices for its goods will need to be increased by at least 2% per year in order to accommodate this high inflation into our cost of production. So future price is going to be present value into 1 plus inflation rate factor, and that's how it has been calculated.